About that. All right, so we're going to start the day with a review of ownership the kind of transition planning process in a way that's, considerations that apply regardless of the path that a company is taking, around setting goals, management succession, which is obviously very key, a key element to the process, and also thinking about business valuation, what you should know and how to think about approaching it. Then we'll get into the different paths to an internal sale. Exploring ways that you can sell business to family members, managers, and/or key employees, right? So small group of employees, and then the sort of full group of employees through the two most common structures for that: the employee stock ownership plan and the worker cooperative. And then next steps and opportunity to kind of get into further questions. So with that, I will pass it off to Lynn to start in on some of the kind of overview of the ownership transition planning process.
Great. So why are we here? Well, all businesses come to an end of the current ownership at some point or the other. They can be sold or given away, or they can be shut down or liquidated. And the challenge is with privately held companies, there's no easy market. You have to create your own market. This isn't like a publicly traded company where you can just sell your shareholding on the stock market in one day and be done with it. So owners need to develop their own exit pathways. And this is very viable. Many people have done it, but it's really on the owner's shoulders to sort out how the company will carry on once they're ready to transition out of ownership. And the planning makes a tremendous difference in the outcome. I've taken people in the market with zero planning, they just were ready to sell. But if you have some time before you're ready to make the transition, whether it's internal or external, you can usually make the transition go much better for yourself. You'll get a better pricing, and the business will run more smoothly once you step out. And we need to acknowledge that this planning is just one more project on top of everything else an owner is doing in their company. So it is good to budget time for it and pace it out. But yes, it is additional effort here. Okay, thanks, Matt. Why plan? You may need to shift your focus a bit. Business, there's not just the pricing, but it's whether the business is saleable or not. And we'll talk a little bit more about that later. When you sell your business, there are taxes on the proceeds, and some planning can help you net more from that. And the planning will also help set expectations, especially with key employees, so that in this particular market, it helps you retain your staff. A couple of things to emphasize here with planning. Anything you do to boost your saleability and the selling price typically also boosts the earnings along the way. So it's not just the end result is better. Usually you do better until the time of the sale. One very pragmatic issue right now, if anybody's taken pandemic support, such as a PPP loan or an EIDL loan, those need to be forgiven or paid back before a business can sell, unless they change the rules. But right now, you can't change ownership of the business until the pandemic support loans are all taken care of. So I know many people are in process right now. That's a good thing to take care of before you want to move forward with the business sale. Business sales also take a team. You'll need a good transaction attorney, you'll need a good accountant, you may need a broker involved, you may need someone like Matt to advise if you're selling to all the staff. So each member of the team has their role, and but you will need multiple advisors to help carry this through well. Okay, next slide, please. So the first question when we look at a business, can it be sold? And the biggest issue, especially with smaller businesses that don't have multiple levels of management, is can the business survive without you as an owner? So if you are, as owner, the chief rainmaker in the business, if you're really responsible for sales, that entire pipeline, that would be something to start working on sooner before the sale, so that others within the organization are capable of carrying on those sales efforts. The same thing goes with if you are the main face of the business and the main contact with your key customers or clients. Those relationships are important to start handing off well before you're ready to make the sale. Another piece of planning early on: are your customer agreements transferable? If you have them with clients or customers. A going concern business, it will sell for a certain price, but it's presumed that the clients and customers stay on. Is there anything you can do to help ensure those people will stay on with the new entity? Practically, if you review those agreements soon with your attorney, if you don't have a clause in there saying that the agreements automatically transfer to new ownership, it would be good to start adding that clause into any future agreements you have. Another thing to keep in mind is that when a business sells, and we'll talk about this more later, the business entity may shift, meaning, say you're set up as an S corporation right now, the buyers may not buy that corporation. They may set up a new entity as a shell, enroll assets of the corporation into it. And that's a very, very common way for businesses to sell for various legal reasons. So if your contract should have language that allows the customer to transfer to the new entity that owns the business automatically, that will save you a lot of issues down the road if you can start getting those into play soon. And now the lease needs to be transferable if it matters where you do business. If it really doesn't matter, then this is not a relevant point. But if it matters, not only transferable, but of sufficient length. By that, I mean, if there's a lender involved, an outside lender, normally they will insist that the lease and the options for extension are long enough to cover the entire term of the business acquisition loan that the buyers will take on. Makes sense. So just something to think about right there. Okay, next slide, please. Saleability. Are the financial records in good order? This is a good time to get everything caught up. You'll also be needing to generate monthly P&Ls and balance sheets. These are needed by buyers to generate their business plan. They're needed by lenders. So those are things that are going to be really helpful for people to have. If this is particularly an issue with family-owned businesses, if there are a lot of personal expenses being run through the business, in this era, many of those things are not things that we're allowed to add back and count as profit. The banks, and this is really since the Great Recession, the banks won't accept that. Since the banks don't accept that, what this means is you need to stop running those things through and instead show higher profitability of the business. That will make the sale much cleaner and much more straightforward, and it will look like you're earning more, which will make the business price higher. So the other issue is the business generating enough cash flow to support its own sale. This is something to think about. First of all, if you're working in it, and any family members, are you all paid at least a market salary? And then, is there any profit left after that? One way to think about this is that the profits of the business are essentially what the buyers will be using to make the payments on the business acquisition loan. So there needs to be enough cash flow there. If there isn't a cash flow, I mean, some sales do go forward, but they're not financed. It has to be a cash sale. Okay, now we're going to move on to Lauren, and she's going to talk more about how to things to look at for yourself and how to prepare your staff for the sale.
Thanks, Lynn. So moving right along, we're going to talk about the planning process and how important that is to look at it as a series of iterative steps. And whether you want to think of it as this pyramid or a linear progression, there are a lot of ways that you can do so in a way that is reasonable for yourself to take on each one of these steps, but at the same time to recognize that the succession of it sort of feeds into the next part of the process, right? So we're going to start off with talking about setting goals, which are so important. It's going to help you to frame what the steps are going to be going forward. And then looking at your resources, and that can be whether it's physical assets or your headcount, key managers who you can see really making a difference and carrying the baton when you're ready to pass that along. And the other thing that you really need to think about are the implications that this change is going to make to your business. So, it's easy to tap someone whom you think is going to be the right fit for the next step, but that's going to change the perception of everyone else in your organization. It sets an example, but also expectations from those around you, and it's really important to be sensitive to that. And then, of course, feeding this into your exit path and making sure that the runway is set up so that you can ultimately fulfill the goal that you had either starting today or in the near term, and ensuring that you're going to bring that to completion and success, ultimately succession. So why don't we move right along, Matt, to the next slide. Thank you. So reiterating the importance of setting your goals. And this may seem obvious to you now, but it's very easy to forget about them and when you're in the middle of the thick of things. So what are the goals and what are the needs, not just of your business, but for yourself, right? So as you step away, what do you need to sustain yourself, your family, the responsibilities that you have to those around you? Is this going to be potentially your retirement? Are you going to walk away from this and move on to another part of your life? What do you need resource-wise to sustain that, and hopefully not have a moment down the road where you say, shucks, I should have hung on longer. Because again, this is going to not just affect yourself, but your family and those around you. And doing it properly is so key. And ultimately, where do you see the business going long term? For many of you, I'm sure these are your babies. This has been maybe your life's work. And there's nothing more disheartening than seeing something like that, unfortunately, fail. So again, setting the goals, having a very distinct vision for the future is so important. And to put into perspective the longevity that goes into this process, typically you say it's going to take at least 2 years. So this is not a flash in the pan experience. If you can do it even longer, the better, because you'll be able to have more time to ensure that you have the robustness to go forward. And at the same time, too, that those around you and those still involved with your organization are going to have a very clear picture of what the next steps are going to be when you do eventually step away from your desks. So have those goals ready to go, and then we're going to move on to some of the more iterative parts of that process. So Matt, when you're ready. Thank you so much. So we're going to be talking about a management succession. That's going to be you getting your managers, getting your key people ready to take over the reins when you step away. So as I just mentioned, time is of the essence. You can never plan for too long. You can definitely plan too little. And that's where the ugly parts happen. And I'll speak to that in a little bit. Starting this process, who's your staff? Who are the people you know have the resilience and the adaptability to step into your shoes? Who, for example, has the customer relationships that are strong and there to continue the sales or to continue to have those stakeholders remain in your universe? What about the regulatory compliance? As Lynn just spoke to earlier, there could be tax implications with anything that you do. Are you ensuring that you are sticking to the rules, not just within your own organization, but with the state and otherwise? And how managed are your finances? Do you have your books straight? Do you know what your valuation is? Are you above the board cash wise and operating in a way that, again, whoever is going to take over for you, whether it be a key manager or maybe even a few working together, how are they going to make sure that they have all of that they need to ensure that they're going to be successful going forward? Slide, please. So planning your management succession is, as I said earlier, it's about assessing your resources, whether they be soft or hard or otherwise. Recognizing what your responsibilities are, it's going to help inform who is going to possibly be that next leader for you, but you really have to check what are their skills, and what is your relationship with them, right? So maybe someone who you've trusted for years would be the right person. Maybe there is someone who you know is intuitively a great innovator and is going to be able to take your business to the next steps in the future to maintain a competitive advantage. Who's very responsible? Who do you know is going to show up in the morning and lock that door at night and be available for who knows what happens in the middle of the night, which I'm sure as small business owners or otherwise, we've all gotten a call at 3 o'clock in the morning because something has happened. So this is when we talk about defining the hats, all right? Who are you? And what have you been wearing hat-wise? And what about your operators and your stakeholders? And I really just want to emphasize what a stakeholder is, because it's not just people in your organization. It is anyone who has a touch point with your business. And that goes as far as your landlord, your neighbor next door, your town, your suppliers, your customers. These are all entities and people who are going to be affected as you step away from your operations, being active in your business. So again, this is really understanding those relationships and the implications that are going to come as you go through the process of succession. So most importantly is the locus of control. At least I think it's important, because control is an interesting thing. It is somewhat based on perception, and certainly comes down to the practical, such as who is signing on the dotted line, right? Who is implementing programs and initiatives and ensuring that those get signed off on. It's important for yourself, but also for the next people walking in. And the reason why I say that, and especially emphasizing the perception part, not everyone is a born leader. And some people whom you actually think is a leader, maybe that is not felt in the same way from other people in your organization. Personalities count. And the way folks operate with other people within your organization is certainly going to affect what or who the locus of control is and what is going to be their future success as being that person who makes makes decisions going forward. So a great way to start mapping out how you've done it at the top of the pyramid, since we're using pyramids today, is logging everything that you do so that whomever walks in is going to really understand what it is that you've done on a day-to-day basis. And I know certainly working with a lot of first generation entrepreneurs, or if you started out as a one man or woman show, part of control sometimes can be keeping information to yourself, right? This is when it's time to put it into black and white and make sure that you are able to pass it along to the next person. Because I can even say from my own experience in a family business, not everyone wants to share their secret sauce, but if you're going to make sure that the succession is successful, you're going to have to get the secret sauce out into the open. So record your important calls. Make sure that you have strong minutes during your meetings. Make it very clear what your purpose has been as a leader and as an owner, and certainly as a decision maker. Because again, perception is everything. People might be observing your actions, but unless you really have it written out there, people can have differing perceptions. So you want to make sure that whatever you're leaving behind is perceived in the same light for everybody. List your responsibilities. A part of being that locus of control and being an effective controller is everyone else has to understand what your responsibilities are. And again, the one-man shop, it's really easy for the founder to have that information kept in their heart, kept in their minds. And this is the time to make sure that the responsibilities are clear for the folks stepping in after you. And then finally, stakeholder engagement. And again, emphasizing that a stakeholder is not just your human capital, but anyone who has that touch point with your enterprise. What does the relationship look like? What is the value to your business? Is it fraught? Is it strong? Is it something that's reliable? Is this a person whom you could pick up the phone and call at any time, or is it a much more controlled or maybe formal relationship? These are all things that you need to pass along to the folks stepping in after you, and ensuring that, again, that there's consistency in terms of the perception across the board. Slide, please. And of course, you need to understand the aptitude of your management. So again, this is a part of that assessment. It's about understanding your human capital. What are their abilities and skills? So founders or people who've been operators, owners, the top of that pyramid for a long time, chances are you've done it all. I've spoken to many business owners where they've done everything from cleaning the toilets to packing up their goods and making sure it gets out of the mailroom, or making those really, really big, difficult decisions. And you want to look and try and find that same ability of resourcefulness and adaptability within your management. So think seriously about their abilities and skills. Make that list, or take that list of skills and activities. Who are the makers, or who are the decision makers who are going to be able to pick up where you left off? Job descriptions, no different than if you are hiring someone and you're just not going to hire good talent unless you have it out there very clearly what you're looking for in that talent. It's the same thing here. Make it very clear what it is that you've done as the leader, and in order to set expectations for the people who are going to step in. And that also applies to the people who are reporting to you, and maybe the people who are reporting to them. Again, clarity and perception is king, and consistency is going to be what makes that all the more helpful to the people who step in after you. And finally, be realistic. I know I've just mentioned about the folks who clean the toilets. Keep it in mind that maybe what you've done for your business, literally putting your blood, sweat, and tears into that, that may work in some levels, but a small firm only has so many resources. So if you're talking about just a few people in there after you, can they handle, right? Can they handle all of the responsibilities that are going to be coming their way? Larger organizations, certainly you have a larger universe of people from which to work with, so it's a different type of paradigm. And then bottom up is a beautiful thing. I think we all know that hierarchy is certainly a part of business, but nobody wants a tyrannical leader, and that is certainly very appropriate in this circumstances where it's a succession can be emotional, it can be a big change, it can be scary, it can also affect your employees where there's uncertainty, right? The highest level of uncertainty for some businesses, or for many businesses, during that succession period. It's not uncommon for some employees to say, oh, that's going through succession, it's going to fail, I'm out. And that's not what you want. A part of making sure that they don't have that sort of trigger or knee-jerk reaction is making sure that you hear from them. They want to be heard. They want reassurance. So doing this in a unilateral way would be one way to open up the possibility of uncertainty. If you have an open dialogue, it's a two-way communication. You're going to be able to reassure your employees, and at the same time too, they're going to be able to air their concerns, and you can, as I said, reassure them. Slide, please. So what is their vision for the future? Again, using the P word, perception. You might have a very good idea in your mind where you think your business is going to be in 5 to 10 years or even thereafter. Is that shared by the people who are in your immediate universe, who are your most important stakeholders? If it's different, your succession is going to be hairy. If they understand where you think the business is going to be going, it should be a lot smoother. And going back to the concept of a bilateral planning, bottom-up communication, that's going to align your visions. Who knows? There's a very good chance that within your managers, there could be someone who has a great idea, a great direction for the business that could be very helpful when you step away, right? That could be incorporated in your succession planning. If you don't know that vision, you could be missing out on a whole lot of potential value building out there. So part of this is going to be setting their expectations. And what you really want to do is to ensure the longevity, because as I said earlier, nothing can be more disheartening than seeing your business effectively go bust, because when you went through the succession process, folks either were not able to pick up where you left off or really didn't know what your vision was. And when you go through that succession process, you could be losing people, they could be jumping ship. So instilling that longevity is important, and having that shared value system and vision is going to be a part of it. Who can you recognize within your employees, your managers, who's going to put their skin in the game and be around for a while, right? Who do you think could potentially be a flight risk? If you see someone who looks like they're coming up on retirement age, probably maybe not the best person to pick, right? All of a sudden longevity is going to be an issue there. And then who's ready to step up in the same vein that maybe you wouldn't want to be thinking about handing over the reins to someone who's going to be out the door in 5 years, who's been there long enough to really understand the organization that you've built, intrinsically have the spirit to pick up where you left off, and also have that desire to be there at the drop of a pin whenever it's necessary. And then finally, too, no matter what, your managers are going to have to step up. They're going to have to expand their skills. Whatever they're doing now is going to be different when they're at the helm. It's no different than any other promotion out there. So make sure that they have the skills to ramp up so that when they are sitting behind your desk, they have the value behind them to really keep things running. Slide, please. Thank you. So how prepared are they? You are going to have to train folks, because again, similar to a promotion or any new job, because effectively that's what it's going to be to them, you're going to have to get them ready to go. And this feeds right back into taking the time to document how you operate right now, right? Back to those meeting minutes, back to your decision-making process, your secret sauce that's in the back of your mind that you bring into the game that helps you maintain the locus of control. That will be part of the training. It will be part of passing off the torch to them. And that's also going to help incentivize their longevity. So also speaking back to thinking about where people are in their career, you want to make sure that they're going to hang around, and there's ways that you can incentivize that. So have them put some skin in the game. This is also important financially for yourself. They should be partial owners, maybe, making sure that they have every reason to put in the hours and the time that you have put in building your business. It should be effectively the same for them going into it. And finally, I'm going to reiterate what I mentioned. Who's willing to expand their skill set? If someone is willing to train on the job, expand their abilities, they're not going to walk away from that position. They would have already invested their time and their mind into the operations of your firm. So the training also adds into making sure that there's going to be a longevity factor there. Slide, please. Thanks. And then finally, what are going to be the expectations? So again, perception is king, and that does also lend to expectations. You're going to hit a challenge regardless. It's like any business. It's not going to go smoothly all the time. There's going to be an alarm bell that goes off at one point or the other, and you're going to have to put out that fire and do so in a way that is effective. Oh, sorry. Going back in time, thank God. So giving you a quick idea of how things can fail. I'm going to give you an anecdote now, and then we'll finish the slide. There's a fabulous business, or was once a fabulous business, in the New England area. I won't mention names. They were a 5-generation family business. So to put that into perspective, the likelihood of a business going beyond a 3rd-gen succession in a family business is 3%. So you can imagine getting to that 5th generation is extremely special. So this family business had managed to do it for over 125 years. But then when they did have that succession to Gen 5, there was very limited ramping up to that successor. They were inherently disinterested in the business. And when they did inherit, they turned around and said, I don't want to do this. The managers hadn't been given any forewarning. There was no roadmap to success. As I mentioned earlier, think 2 years or more in terms of building that roadmap, aligning expectations, aligning perceptions. That never happened. The managers, many of whom had been in that business for 35 to 40 years, had put their lifetime, really their professional lifetime, into that business, said, well, okay, the kid doesn't want it. I guess we'll take it. We'll step up. Cool. We're going to be business owners. Sounds great, right? But what they found out really quickly was that actually they were not really qualified to be at the helm. They were really good at what they had specialized in, but maybe they weren't the right person or people to be wearing the multiple hats, to be the person who gets the phone call at 3 o'clock in the morning when the burglar alarm goes off. Suddenly they realized that they were not the same type of animal as their predecessors. So what happened was basically over the next decade, the business became fairly dysfunctional. They started losing capital, and they did not reinvest in the business. So a decade later, it was in total disarray. The managers who had bought into the business effectively lost their investment. And they were sitting there with a business that was worth effectively nothing. Eventually what happened was that they were bought out actually by their external accountant, who literally got to buy the business for pennies on the dollar. And it is now an entirely different entity. All the same employees are gone. It was devastating for that business. So that's an example of bumps in the road and not being ready to really address them. So again, recognizing that need for training and the opportunities early on to get folks incentivized to take after your role, identify who the next owner is going to be, or what that ownership is going to look like. How is it going to be transferred? Tapping an individual or pointing at a certain individual who is going to be doing so is going to immediately change the perceptions of your other stakeholders in your business, for better or for worse. Be prepared for that. Consider how people are going to see what the next chapter for your business is going to look like. And then finally, ensure that your effective commitment is strong. So effective commitment is a sort of an HR term, which means how committed emotionally are your stakeholders, particularly your human capital in your business. Are they willing to step in the same sort of emotional level that you've had as the owner operator of your business? Ensuring that is a great way to make sure that they're going to really be there for the tough times and for the good times as well. So that pretty much wraps our section, and I will hand it over again. Thank you, Matt.
Thanks, Lauren. Now I'd like to talk a little bit about business valuation, and this will just be conceptual. because we're talking about doing evaluation in early planning stages to help inform your decisions. So business valuations can be run at multiple levels of complexity, everything from what we might call back of the envelope, where you look at your sales and find a rule of thumb is like, okay, businesses will likely sell for this realm of our total annual sales, to what I call a basic valuation, which is actually compiling data from a number of years, normalizing the earnings. For example, if family members are not being paid at market, you need to adjust for that, which impacts the earnings. If you own the building but are not charging the business market rent, we adjust for that. And interesting things can jump out when we actually spend time looking at the numbers in a little more detail, and sorting those interesting things out well before a sale can definitely help the sale go more smoothly. And then there's the more complex business valuations, which are legally defensible. You'll need an accountant with the certifications to do that. And that's something that you would likely need if you were doing a sale that involved a sale to, say, a family member, which is not a third party. Since it's related parties, the IRS does insist on a more complex valuation. And also ESOPs need a more complex valuation. So just conceptually, there are different levels that you can run a business valuation at, and you can just choose the one you need for your purposes at the moment. For early planning, I do recommend a basic valuation where someone compiles the numbers, normalizes the earnings, and you'll have a better sense of what's going on in the business. So one of the first questions, of course, when you have that valuation run is, will the proceeds meet your financial needs? And this may be a good time to loop in your financial planner. This is an iterative process. If the proceeds aren't going to do it for you, what most owners do, they stay in the business, run it a little longer, keep taking income, and grow the business up so that it's worth more when it sells. So the valuation feedback often helps owners set the timing of the sale. It's a really important step to take. If the valuation meets your needs, then the sale is at your discretion. If it's not going to meet your financial needs, then you may want to hold off a bit. Most business owners, yes, overestimate the selling value. It's the blood, sweat, and tears basis, but unfortunately, when we evaluate a business, it's based on earnings. And a good valuation will give you feedback as to whether the business is saleable. There are some valuations I won't even take these days. I mean, I haven't seen a video store in ages, but when they were on their last legs, it's like, it's hopeless. You're just going to liquidate your inventory. Even print shops right now, print shops are, as an industry, are not as strong as they used to be. You'll also get a good sense of the likely value range, and the value is a range. It's by very defensible valuation approaches, different valuators could come up with different numbers, and they could all be perfectly valid. At the end of the day, it's what you can get somebody to pay for the business and the financing entity to lend on that is going to be the final value. Also, understanding what brings value to the business and what detracts. For example, a retail shop, adding more inventory does not add value. Selling more inventory adds value. You want to turn what you have, but too high levels of inventory will detract because you're not earning enough on what's there. And then identifying which exit pathways might be viable for the business. For example, very small businesses with a handful of employees, the best option there is usually a sale internally, because there are very few external pathways that are viable. It just aren't going to get the attraction of a lot of buyers out there. Larger businesses that are quite profitable, yeah, you may get a synergistic acquire, another company in your industry who wants to set up in this region. You may get a private equity group. So it depends on the industry and the profitability as well, what your options may be. Okay, could we go to the next slide there, Matt? Thanks. So value, why do people buy a business versus starting it up? Because they want a sustainable turnkey operation that can continue to thrive, but without you as its owner and operator. That's why you buy one. Value drivers, when you know what brings value, you can focus on that during your planning process. Everything from having staff well trained, established transferable customer base, which I had talked about before, a history of revenue growth and consistent profitability. Okay, we're in a pandemic, so let's address that. What's going on in the market right now with the pandemic? So companies have experienced this in different ways. As we've all seen, some companies have gone under, they could not survive. Others have taken a pretty serious hit to sales and to profits as well, because our operating expenses have bumped up, given what's needed to play in this era. So they are still in recovery mode. They're not at normal operating levels. Other companies, and I have one on the market right now, saw a blip during the shutdown for about 3 months and now are going stronger than ever. So it depends on your industry and a lot of specifics. Can you keep your workforce? What's going on there? The profitability issue may impact your timing right now. That's just something to consider. Does it make sense for you to fully recover before trying to sell to your employees, or could you do it now? You know, it's just something to consider. Another thing to consider, which impacts profitability, is capital expenditures as you're running up to a sale. Every business needs to spend on capital improvements, but if the spending will not result in higher profitability before you intend to sell the business, then it may make sense to reconsider whether that's a capital expense you might want to do at the moment. You want to see payback on what you're doing. Other value drivers are good business processes, and Lauren was speaking to that, and a well-known and positively recognized image. Something not shown on this slide are value detractors. Something I mentioned before, a major detractor to value would be all sales are done by the current owner. If the pipeline is entirely dependent upon the owner, that's a very difficult business to transfer to new ownership. And key customer relationships as well have to be transferable. Another detractor that we haven't talked about yet would be a customer concentration. That's when a significant portion of the company's sales go to one single customer. That cutoff depends on the industry, on who's lending the money for the sale. Anywhere from 10, 15, 20% of sales with one customer may make it difficult to move forward. Not necessarily impossible though. So if you are planning a sale and you have a customer concentration, I'm not saying get rid of that customer, definitely keep that wonderful customer, but can you get some other customers to diversify, so not as much as relying upon that one customer? And if you have a customer concentration, can you get that customer under a transferable long-term contract so that customer already automatically goes with the business sale to the new owners? I did this a few years ago, had a company that had over 30% of its sales to a single customer. It was a great customer. So they went out and they changed the wording in the contracts so that the contract would transfer to the new owners, and it worked. We got a multi-million-dollar sale off that. So these are things that you could plan for in advance and just take care of so that it doesn't hang up the sale. Next slide, please, Matt. So valuation, this will just be a general overview. No numbers today. But we look at prior years' financials. Generally, 5 years is what is expected. Maybe 3 if somebody is looking for a minimal approach, but particularly with the pandemic, it's nice to see how the company was operating before the pandemic impacted its performance. We then do what's called normalize the earnings. For example, interest expenses are added back to net income because that expense will be different for any owner of the business. As I mentioned earlier, if the owners or their family are not being paid at market rate, we adjust the earnings appropriately as for the rent. We then weight the earnings, we're trying to come up with a representative normalized earnings for that business. And there can be some weighting to like, okay, if a company's on a heavy growth curve, we often weight the most recent earnings. If you're selling a larger business, as I do, going to private equity, they'll look at EBITDA, the earnings for the last 12 months and heavily weight that in what they use to determine the pricing for that business. We then have the normalized earnings, and then we identify the appropriate multiple on those earnings or capitalization rate. You'll see both terms used. A multiple, as the word says, we just multiply that by the earnings to get the value of the business. At capitalization rate, we divide by the earnings to get the price, the value. Mathematically, one is the inverse of the other. You should come up with the same value range by either approach. We then calculate the value and apply a discount if appropriate. So if you sell a minority portion of a business, if you're not selling the whole business, say you sell 20%, that 20%, it may not be valued at 20% of what the entire business is valued at. That is because that smaller portion has no control over the business and it's not marketable. I mean, whoever buys it can't readily sell it. So there's normally a discount applied. Conceptually, a couple things to understand about valuation. First, say we're talking multiples on earnings to get to the valuation of the business. The multiples get higher as the earnings get higher. So it's not linear. And the multiple on a small business would say 10,000 in earnings is much lower than the multiple on a business with $500,000 in earnings or a business with $1 billion in earnings. So when we see things in the media about a business, a huge business that sold at, a 15 times multiple on earnings, well, that's not what's going to happen for a really little business that might be 2 or 3 times earnings. Just something to keep in mind, but also something if you're trying to grow your business to increase the value, then growing the earnings may help you more than you think, because the multipliers may also come up at the same time. Okay, thanks. Can we have the next slide there, Matt? So now we're going to look at pathways for selling internally. The first is transitioning within the family, and the second is selling to one or more key employees or managers. And the third is selling to all the employees by one of the mechanisms, either an ESOP or a worker cooperative. Okay, now we see the next slide. So selling to family. In my experience, this is the most difficult transition. It can be done, absolutely. It just has human dynamics going on that aren't necessarily as prominent in other types of sales. there's a complexity here. Good communication, good transparency, and patience will take these sales through. You know, a family business, you can keep the business in the family. The parents can, or the owners, if their parents can choose to bank it as well, which will help their cash flow and tax situation. There's always that tension between, okay, the parents have built this up, need this to retire, and the younger generation wants an opportunity without overpaying. This is where having a third party outside valuator helping can help the negotiations there. And as Lauren was speaking to, the family successor needs to be able to do the work. And if they can't, that may stop that option right there. And then considering the non-active family members, because this may be part of the legacy and the inheritance of the older generation. How can this be handled in a way that's fair? Next slide, please. So there are particularly attorneys and accountants who specialize in these types of sales because there is wealth transfer going on in estate planning. It's good to loop them onto and bring them onto your team. This is a situation where you do need a full-blown valuation because of the setting of fair market value required by the IRS. In other types of sales, say if you're selling internally to a few unrelated employees, there's often some flexibility in the pricing you agree, and many owners will, they'll see the range of business value and they may bring in some flexibility to make it work all around. Okay, next slide, please. Selling to key employees or managers. This is very, very common with smaller businesses. This is a way to retain your staff if you've talked to them about this in advance. And this may influence who you hire because you want to be sure there's a successor coming down the line as you're getting ready to move on. Okay, employees generally do not have the money for the traditional bank financing for down payment. This is where flexibility comes in. We've gotten these to work by having the staff start to buy in over several years, and they get to the point where they have enough equity where they can finance the rest for a bank and you can fully exit as owner. You may have some seller financing in the mix, and the buyers can also use SBA programs that guarantee bank loans to lower the risk to the bankers. So these are workable, as just the financing traditionally takes a few go rounds to make sure all the pieces come together here. Now, I believe our next slide brings us up to the option of selling to all employees, which Matt will talk to us about.
All right. Thank you, Lynn. Yes, and this piece is what our organization, Vermont Employee Ownership Center, specializes in. So selling to the broad group of employees. So we define broad-based employee ownership as arrangements where all full-time equivalent employees have a path to becoming a co-owner. They're not necessarily owners immediately upon coming to work for a company, but that's even as they join, they see themselves on a path to becoming a co-owner, which can create ownership culture and some other interesting things. The two sort of main models that we work with, although there are some other approaches, are the Employee Stock Ownership Plan, or ESOP, which is a qualified retirement plan that can own company stock on behalf of employees. It's for generally larger scale companies. There's some compliance and other things around it that are offset by tax benefits, but generally our kind of rough estimate is if you have at least 20 employees, it's worth at least looking into. And then the other model, which tends to be much smaller companies, but not only much smaller companies, is the worker cooperative, which is a form of direct ownership versus ownership by a retirement plan and has more direct governance as well. So for ESOP, there's it's a pretty widespread model. There's about 6,500 of them in the US, more than 30 operating or headquartered in Vermont. A lot of companies you might recognize, King Arthur Baking Company, Gardner Supply, PC Construction, wide variety of industries. One of the key things to understand about this is the ESOP. There's an ESOP trust, again, it's a retirement plan that purchases stock on behalf of employees. And it's held in something that looks very similar to a 401k. But the key thing to understand is the employees don't directly own the stock as it would be like a brokerage account, but it's kind of in this plan administered by a trustee. So the company pays the costs, not the employees. So it makes pre-tax retirement contributions. Those retirement contributions can then be used to buy company stock and pay down loans if you're doing kind of a leverage transaction. So in terms of who votes the shares, one of the key things to understand, this differentiates it from the other model, the Warford Cooperative, is that the trustee has a fiduciary duty as a regulated retirement plan to its employees as retirement plan beneficiaries. So in most ESOPs, the trustee is the sort of agent who votes the shares, say elects the board of directors, that sort of things. There's a lot of flexibility. So there's some ESOPs that tend to have more employee involvement in governance, but the baseline tends to be that the trustee is responsible for the governance for that governance role. And there are pretty significant tax advantages for this model, both potentially for seller and for the company. A company is an S corporation that does this. It can operate pretty much tax-free because if it's 100% owned by the ESOP, because the ESOP is the tax preferred retirement plan, and the employees will essentially pay tax on their retirement benefit when they receive it. But from a company perspective, it's a pass-through entity that passes through to this tax advantage vehicle. And from a seller perspective, the company is a C corporation when it's sold. The seller can roll over the proceeds from the sale into qualified replacement property, sort of similar to a 1031 exchange, and defer paying capital gains taxes as long as they hold that property. So some advantages and disadvantages of the employee stock ownership plan as an exit path, right? One is that from a timing perspective, it allows the selling business owner they want to do a gradual exit to sell a bit at a time over time, and do it kind of on their own schedule. So one example of this was Gardner Supply Company, who spent probably 10-15 years making some contributions to the plan, gradually growing a slice of ownership over time until their founder was ready to have a liquidity event, and first went up to 49% and then sold the remainder to the ESOP. It's very tax efficient, right? It's one of the only ways a company can essentially write off, when it comes to debt, can write off both principal and interest payments because you're paying these pre-tax retirement contributions. I mentioned the possibility of deferring capital gains taxes, so that's something worth analyzing in addition to the top line price received for the company, but also the kind of the if you're using that, the other tax benefits. And from a company perspective, it can help create a really strong culture, right? If the company sort of combines this form of ownership with with things like open book management and other high participation management approaches, there's a lot of research that shows a real significant boost to company productivity because you've got a lot of folks who all have a stake in the company and its outcomes kind of rowing in the same direction. On the sort of disadvantages side, it's because it is a highly regulated retirement plan, there's fairly high setup costs and ongoing fees, right? We're talking, probably to set up something somewhere in the range of $100,000 to $150,000, and then every year you do evaluation, and you have to have a plan administrator and some other kind of carrying costs. So oftentimes that is offset by the tax savings, but you need to sort of do some analysis about the cost and benefits before making that decision. Right, you need a suitable employee base, and it's not just size, but also as people leave, there's kind of repurchase obligations to buy back the shares. So you need to look at demographics and to look at the culture to a certain extent. Say, is this a place where we could, there's the foundations for a really good ownership culture. The complexity of it relative to other forms of ownership. Again, you're going to have to have experts who really understand the model help out, which can increase the costs. And that compliance and regulatory oversight, where you're dealing both with the Department of Labor in terms of the retirement plan elements, and then also the IRS in terms of, because of the tax advantages, they want to make sure that that's not being abused. So, there's a really vibrant community of ESOPs in Vermont, and many of their leaders are often happy to have a conversation with folks who are interested in considering this option. So, that's certainly something that if you want to get in touch, and we'd be happy to set up introductions, and we do an annual conference that also brings that community together. So the second model for broad-based employee ownership is the worker cooperative. So there's a wide variety of kinds of cooperatives in Vermont. There's food co-ops that are owned by their customers. There's agricultural co-ops that are owned by farmers and market their produce or their milk through the cooperative. The worker cooperative is, as it sounds like, owned by its employees. So there's about 20 of them in Vermont, about 500 in the United States. And unlike an ESOP, it's a form of direct ownership. So each member buys one share, and that share entitles them to elect the board of directors and to share in profit, usually on the basis of hours worked, although sometimes W-2 income is the metric. So each year, profits, you look at however many of the employees are members, you divide up the profit by that hours worked metric or whatever the metric is for tracking labor contribution, and then there's essentially a profit share there. Employees don't become members immediately upon joining the cooperative. There's usually a trial period, and it's different for different companies. Again, it's much less standardized than the ESOP because it's a direct form of ownership. But generally, it's something between 1 and 5 years where you want to see someone's really a good fit for the company before you offer them the opportunity to buy into becoming a co-owner. While the board of directors and the governance is democratic in terms of that one member, one vote amongst the members, management can be pretty conventional. You have a general manager who reports to the board. That general manager has higher and higher power of employees. And there are some co-ops, tend to be smaller ones, that will do more kind of flat or high participation forms of management. And so the worker co-op is a good alternative for smaller companies interested in employee ownership. I'd say something as small as 4 or 5 employees, it can really be viable as long as, again, some of those key things that, say, Lauren was talking about in terms of management succession have been worked out. And we do see examples where a business owner who's not yet ready to retire, but wants to have less ownership responsibility will be on the book buy and the sell side and become a member of the new cooperative and stay on as a manager for 5 years or 10 years or something like that. So in terms of the steps for kind of making this particular kind of deal happen, generally it starts with an owner exploring the concept, doing some reading, having some conversations, deciding whether it's something that feels like a good fit for the company. Then doing feasibility assessment. Oftentimes this includes that valuation, right? To get a sense of, is this something I want to do? But you also want to look at operationally, is there that management capacity, et cetera. And if you run the numbers and it seems like the company could support the amount of debt that would be needed or other sorts of financing, you generally do a presentation to the employees and say, hey, is this something that you're interested in? If there is interest, then there's an opportunity to recruit a steering committee of employees who will essentially represent the buy side of the transaction. And this is another place that's different than the ESOP, where generally the employees aren't going to be involved until the end, and it's the trustee that, again, they have some legal responsibilities, but their job is to represent the buy side. Whereas in this case, you're going to have an employee group. The employees will do a bit of work around, we're looking at their bylaws, bylaws for the new cooperative, generally doing a review of the existing business plan and updating it, and then talking to potential capital providers. And there's a number of capital providers that specialize in lending to co-ops, and some of the unique elements there, like the Cooperative Fund of New England is one of the major players in our region. Once they've done that, then present to the rest of the employees and say, hey, is this something that we all want to do? Do we have a critical mass of folks who want to be co-owners of this business? Then if yes, then they move forward to negotiate and agree on a price, and then nail down the details, the financing and incorporating and this little legal work before transacting. The seller might have some concerns around control or other things, especially if they're seller financing, that they would want to address. Oftentimes this means that there might be a covenant in a seller note or loan that says the seller has the right to veto certain decisions or a seat on the board or something similar until the loan is paid off. And if management succession is part of this, there might be an employment contract that says, okay, the seller is going to consult for 2 or 3 years and provide some support for the transition. Once all of that transactional work is worked out and the transaction happens, and as Lynn was talking about, it could happen either as an asset sale or as where a new entity is incorporated and buys the assets of the old company, or it could be restructured, the existing corporation as a worker co-op. There's some considerations that can kind of go back and forth on that front. And the former owner this could be their chance to ride into the sunset. This could be they decide to be an employee. They could have like a consulting contract that kind of reduces that kind of steps down over time, or they could decide that this is something that they're excited to be a co-owner of this business with their employees and become a member. And I'd say probably like maybe a third of the activity we see are more mid-career folks who are interested in that. And 2/3 is more in that ownership succession, retirement, stepping away from the business realm. So I'll pass now back to Lynn to wrap up of the remainder of the slides, and then we'll open it up to any sort of questions or comments from folks.
Thanks, Matt. So once you've started the process of selling the business, the planning is done, you're ready to start moving the process forward. It often can take a good year from start to finish, getting the financing and getting to the closing. Just wise to plan that. And the other thing is, as mentioned earlier, you're all still doing your day jobs on top of the sale, which is an additional project. So pacing it out, having deadlines agreed with all the players so everybody knows who needs to get what done in the next week or two can be helpful. It can also be very helpful if you as owner provide the financials and sit down with the buyers to help them do the projections they'll need for the business plan. You will know these inside out. They're getting up to speed with becoming owners. Allowing, if they need to meet with each other, the buyers, if you can carve out time during the workday, that could facilitate that. But it's also totally fair, because they're becoming owners, to send them individually home with some homework to get themselves up to speed. They've got to learn and really learn how to become an owner of the business. There are no guarantees that any particular transaction will move forward. If one concept doesn't work out, stay with it, pivot to a different approach, see if you can get that to move forward. I just don't give up, just have patience, work at it. Buyers' life situations change continually as well. What may have been a good situation for somebody this year may not next year, and vice versa. So, and it is a stressful period for everybody. Whatever you do to take care of yourself, it's good to just do more of that. Next slide, please. So when you're down to the nitty gritty, the negotiations, it's not just the price, it's the terms. We see things in the media about what pricing somebody got for a business. That doesn't mean a whole lot unless we know the terms, particularly what was included, what was excluded. These things are all negotiable. There are things you could do, such as earnouts, where part of the pricing is contingent upon something happening in the future, usually a certain level of sales being met. Escrows, holding back some of the cash in order to protect for liability. Seller financing, very common. Ever since the Great Recession, I've been seeing seller financing as part of almost every deal that involves an outside lender. They're going to want, so you may have more than one lender on every transaction. There's tax advantaging strategies to look at. This is where you really want your accountant involved to advise here. Matt was talking about, you can transition as a corporation, or if you go as an asset sale, you're going to allocate the purchase price. There's ways to improve your position as the seller. Another term to be aware of as part of your planning is that most buyers, or their attorneys, if they have a good one, will insist that the selling owners sign a non-compete agreement. That's something, you could still work for the company under, a consulting contract or as an employee if they choose, but it means you can't work for a nearby competitor. So if that impacts your plans for moving on, that's just something to put into the mix of things you're considering right now. I guess we're at our last slide there, Matt. So keep your goals in sight and just stay at it. Don't forget why you started this process. And when it works, and most of them do, it's a great win for everybody. Everybody's happy at the end. And I'm always grateful that one more company is staying in business in Vermont and keeping our economy going. So thanks for all the efforts you're putting in, learning how to, move your company on to new owners. It will pay off for everybody. It's a wonderful endeavor here. So on that, I think we're going into general questions, right, Matt?
Yes, so feel free to both put any questions or comments you have in the chat here, or if you want to, I think you should be able to kind of raise your hand or unmute if you want to just ask a question directly. I will also put up, we are all happy to have further conversations, or if you want to kind of reach out with questions individually. So first, this is Lynn's contact info, if you're interested in grabbing that. And I will also send out a recording of the of this with the, so you'll be able to see the presentation to attendees. So you should be able to, if you want to kind of go back and review any element of the presentation, that will be available as a resource as well. So here's Lauren's information. And Lauren, actually, do you want to, I'm sure some of the folks here are familiar with the Small Business Development Center, but do you want to
Sure.
just a couple words about what SBDC offers as well?
Absolutely. So the Vermont Small Business Development Center is one. Well,
those look great.
Sorry?
Thank you for doing that.
Okay, sorry about that. I will continue with the pitch for the VTS-BDC. So we are this sort of the state level entity of a bigger organization. You may have heard of the Small Business Administration, which is on the federal level, the national level, and national SBDC. We operate as a free resource to small business owners here in the state. We can help you across a variety of different challenges or issues that you might have as a business owner. My specialty, as mentioned earlier, is advising folks in sustainability. So whether that be building resilience, adaptability, and mitigating social or climate problems, succession and family business. A good deal of our other advisors are either regionally focused. So if you're in Chittenden County, there would be an advisor for your area, and others who have their own specialties. So we have a fabulous advisor for breweries, for example, among other things. So I urge you to check out our website. As I said, we are a free resource. You get your very own business advisor who will help you navigate the road to success as a business owner. And we hope to hear from you.
Great. Thank you, Lauren. And then finally, my contact info is here, matt@veoc.org. So we did get, so one person sent in a question here. And so I'm going to stop the recording now, but still we'll answer questions if you want to throw them in the chat.